Welcome to our market insights. We do this quarterly. I'm going to give you a quick rundown as to all the things that Capita does to try to communicate with clients on a broad basis like this. I'll give you an introduction to Ryan and Tim. They have both been on before, so maybe not as long of an introduction. And there's a lot going on right now that we want to talk about. In fact, Ryan and Tim and I were just talking and determined that we probably won't dive into the slides in the first few minutes. The slides are going to be important, and I do want the visuals to come out, but we definitely need to talk about the conflict right now in Israel and decide and help everyone understand and put that in perspective as it relates to market activity and your investments. So we'll get into that specifically. Tim Holland and Ryan Dressel are with Orion. Orion purchased Town Square. So if you're familiar with the name Town Square, Orion and Town Square together. We've actually used Orion software for a long time prior to prior to Orion purchasing Town Square. So we really like Orion software. They are what's called an outsourced chief investment officer. So you see that those four letters after their name, OCIO. So these folks are spending 100% of their time analyzing markets, looking at portfolio construction, making adjustments to that, analyzing money managers who analyze individual positions, and making the list for an investment advisor like us curated down and triaged into the best investment solutions that we can put together for you. And then it's our job to take that menu and apply it very specifically to what you need and customize it to you. So that's where your Capita Financial Advisor jumps in. But that's the general job of Orion, is to provide those resources and that outsourced chief investment officer role for us. So Tim is the chief investment officer of the Orion OCIO business, and Ryan Dressel is a senior investment strategist. So as we get talking, you'll see whenever they really need to get into the weeds around like, well, wait, give us visuals, get the data, that's Ryan's world. And then as it comes to like macroeconomic understanding of how it all comes together, that's Tim's world. And so the two of them together are going to be able to cover a lot of questions and help us understand a lot more. So in understanding what Capita does from a communication standpoint, I just want to throw that out there so you know what today is as well as what's coming. Every quarter, so every 3 months, we do a call like this where it is a very open discussion around what's going on in markets. Every 6 months, we do what we call a boot camp. We have a fall boot camp and a spring boot camp. The boot camps are designed to educate, and usually the topics within the boot camp are more what we call evergreen. So you could learn from, well, let's just maybe take a step back. Like this quarterly market update, it feels like every quarter we're talking about completely new things because the market moves so fast and data is changing so quickly that it's not very evergreen. I wouldn't go listen to the ones 3 and 6 months ago because they're just not as applicable to today's market. However, the boot camps we do every 6 months, those are going to be more long-term things. If you learn them, you will be more successful financially throughout your whole life. So it will be concepts around portfolio construction or concepts around estate planning and family decisions and tax strategy that could be used every single year for the rest of your life. So there's a key difference between those two things, and it's important. We like having you join both because you learn what's going on right now with our Orion team, and then you also get a chance to learn things from a financial planning and wealth management decision-making process that affect and help you throughout the rest of your life. On top of that, we're putting out every 2 weeks a podcast within the Guided Path season, 8 different seasons, about 5 episodes per season on the Financial Call podcast. Each season dives deep. So you have investments, and it goes from basic to options and derivatives and leveraged, and it basically takes you from start to finish. Same thing with Social Security, same thing with income planning. We are currently we're inside the season of charitable giving and charitable strategies. We just finished the one for business owners. So you can pick your season and consume it as you need. Also, there is written content especially called the Money and Mind article series. So 7 articles around how to handle your money in retirement, 7 articles around how to handle the transition mentally into retirement, And that comes as one big booklet too. We actually have a couple hundred of these printed in the office. So if you determine that you want one, just let us know and we'd be glad to give you one. If there's a particular article you want, we'll give you hard copies of that. And they are all available on our education center on capitafinancialnetwork.com. So you can see we're trying to get as much out there in whatever medium is appealing to you. And so I will just take a look. Well, first of all, somebody said they can't hear me. Maybe let me know if you guys are hearing me okay in the chat. And then Liz, boot camps are recorded. You can go back and listen to the older ones. They are listed in the capitafinancialnetwork.com website in the Education Center button at the top. Okay, great. I'm glad you can hear me. So up there at the top, there's a button called Education Center, and you'll find all of it there. In fact, I've already got it up here. I'll just do this real quick. This is the home website, and then the Education Center is up at the top. And then these are all the topics, and usually current events is where you're going to find these quarterly market updates. And then the boot camps are in here as well. If you want the Money in Mind articles, the full PDF is there. In fact, I just tested this morning. It wasn't working, but it looks like we got it back, which is great. Quick turnaround for the team. That's great. That's it. So with that being said, first of all, before we dive into the Gaza-Israel conflict, Tim, Ryan, have I missed anything that you feel like we need to talk about with regard to like your roles, introductions, anything else that we need to maybe just touch on to help give some flavor as to what you guys are working on before we dive in?
No, I think you covered it really well, Zach. I would add that beyond sort of the opportunities, which we really appreciate to connect with your clients, and the work we do from a portfolio perspective and an asset allocation perspective and research perspective. If anyone on the call ever has any topics that they'd like us to dig into, the folks on the webinar, ping Zach and Ryan and I are here to dig into industry issues and market issues, and we always want to hear what the folks we work with are concerned about. So if there's ever anything that you'd like to maybe peel the onion on, please reach out to Zach or your contact at Capita, and we'd be happy to jump in with both feet. So just would want to mention that.
One thought too about Tim. So Tim will be in town on November 14th. That is our next boot camp. And the topic that Tim will, so the 3 topics we're going to hit, and that's usually what we do is we bring in 2 or 3 speakers and we hit 2 or 3 topics. Tim is specifically going to talk about the dollar and de-dollarization and the risk of devaluing the dollar and understanding how that's a broader theme that lasts for a long period of time rather than what's happening this week. And so that's why it's a boot camp topic that we'll talk about in about a month, right? And then we will have one of the managers from Alta Capital talk about how one individual US stock manager is looking at analyzing US stocks right now in particular. And then I will do a third of that session on the tax changes coming after 2025. So a lot of people may forget, but we've had some pretty nice tax cuts that are scheduled to sunset after 2025. And that creates some planning that you may want to be thinking about in 23 and 24 in anticipation of that, and 25. And then in 2026, those rates and everything will change. So you have about 2 years and 2 months to try to take advantage of some of these lower tax rates and tax brackets, and then things should change. But of course, that's all subject to what Congress decides to do with it. But that's the point, is we're going to help you in those boot camps. That is November 14th in the evening, and we're about ready to send out announcements for that as well. Okay, let's dive in. So everybody's thinking about the conflict right now. Can you help us put some perspective around it in terms of, I mean, obviously there's ethical issues. There's a long-standing battle over specific territory over there and right to it and religious concerns. But obviously your expertise is going to be more along the lines of how does this affect commodities, investments, and markets. Can you give us a little bit of your understanding of that?
Yeah, happy to, and looking forward to seeing everyone next month at the boot camp, and really appreciate the invitation to come out. And the dollar and sort of the outlook for the dollar is a fascinating and to Zach's point, sort of a broad, deep, evergreen kind of topic, and one we're looking forward to digging into. And to Zacc's earlier comments, we have a market outlook presentation, which we will pull up. We think it's still relevant, the narrative that we'll share with you, but obviously a lot has gone on in the last week or two, the horrific events in the Middle East and a conflict at a scale we haven't really seen since the early 1970s. The Yom Kippur War 50 years ago is the last time you've seen such a level of violence. So, we're not military tacticians or strategists, and we're not meaning to make light of the horrific events at all by pivoting to the economy and the markets. But to Zacc's point, that's our area of expertise and where we spend our time. And so our thoughts would be, as we sit here October 11th and Israel gets ready for what seems to be a massive land campaign incursion into Hamas controlled the Gaza Strip. Our 2 cents around how this will impact the markets and the economy hasn't really changed since all this started, and it's played out the way we thought it would, which would be there'd be a bit of a knee-jerk reaction in the oil markets, and you'd see a spike in the price of West Texas, and Brent is the international benchmark. West Texas Intermediate is our benchmark, and you saw that on Monday when the price of oil was up $3 or $4. Since then, the oil market's pretty much given all that back. Iran obviously is sitting on pretty meaningful reserves, but because of still pretty meaningful sanctions, their ability to export oil has been limited for years now. So they do sell oil on the international market, mostly to Russia, mostly to China, but it's a nominal amount. So we expected a short-term spike. We got it, and that spike has unwound. And so that's played out the way we thought, and oil's down again today. The other thing we thought would happen, and you didn't see this on Monday because the bond market was closed for Columbus Day, the stock market was open, was you'd see a flight to safety or quality. And so as you think about safety and quality, even with all of our problems, and we're going to talk about DC in a minute, the US is still the best house in a troubled neighborhood. So we thought global investors would buy our bonds, and that's what you've seen the last couple of days. So the big backup in bond yields, which we'll talk about, and how that backing up in bond yields really hit stocks in August and September, that's unwound by about 30 basis points, or about a third of a percentage point, which is a pretty meaningful move in a couple of days. And so people buy things during periods of distress that they feel particularly good about. It's sort of like, as individual investors, if we're worried about the markets, we'll go buy some government bonds or we'll put some money in cash. And that's what you've seen play out globally, this flight to quality. And there's nothing safer than the US 10-year note, in our opinion. So those two things have played out the way we thought they would play out. Barring this, the events on the ground in the Middle East turning into a wider regional conflict. And by that, I don't mean, Israel making tactical strikes at Iran, or Iran engaging Israel through proxies like Hezbollah in Lebanon, and obviously the Hamas and their actors in the West Bank as well. Barring this moving to a regional conflict, and by that I mean Israeli tanks on the ground facing off with Iranian tanks, our thinking is Israel will regain control of its borders, will deal with Hamas. It's going to be a very, very difficult situation, and that the conflict will, to a large extent, dissipate over time. As shocking as this has been, as horrific as it's been, as unprecedented as it's been, at least in the last 50 years, it goes back to this dynamic, to Zacc's point about disputes around land and water rights and religion, that's played out for hundreds, if not thousands of years. And we don't think it's going to solve itself anytime soon. And there will be some reversion back to a status quo, which the world will be okay with. I don't mean to sound hard-hearted or cold about it, but we think that's where it's going. And its impact on our markets and our economy have largely already been felt and have been nominal at best. So that's our thinking as we sit here today. So hopefully that's helpful, Zacc.
So if I were, yeah, I think it is. So if I were to, I try to think like, okay, because I talk to a lot of our clients, I try to think, how would a client understand or feel this? So I hear you saying while horrific and while sad and while difficult, the impact to their personal investments may have already been accounted for in the volatility we've seen recently. And what we have seen, when you say the word nominal, means that it hasn't been as horrific as the actual events are. The portfolios have weathered it much better, of course, than the actual impact to lives. And we're thinking that we will get back to a status quo before too long, but the status quo is still an unfortunate, ongoing, multi-year, multi-decade, multi-century conflict. But the world may accept that as okay in the short term. And I think people are nervous about it, but that's interesting to hear you say that.
Yeah, no, that's there's no, and you know, beyond, this is beyond saying the obvious. So there's no obvious solution here, right? You have actors in that region that don't recognize Israel's right to exist. And with Israel, you have a democracy that's been in place for 75 years now, home to millions of people, one of the world's most vibrant economies, that isn't going anywhere. And I don't know how you solve for that. So as horrific as the events of the last couple of days are, and my guess is the events of the next couple of weeks will be, I think the world expects, as do I, a reversion back to this stalemate, the status quo, where no one is happy, but no one has an alternative solution that's acceptable to any meaningful number of actors in the region. And every 3 years, 5 years, 10 years, this awful movie gets played out again, and then again, and I just don't see an off ramp for this. I think as long as we've lived with it, we'll continue to live with it, and it only becomes existential when it pulls in the bigger regional powers, which then pull in the U.S. in a more meaningful, direct way, China or Russia. Then existential risk is introduced. If it stops and starts with Israel and Iran acting through proxies, and the West Bank and Gaza and the Golan Heights and Lebanon, where Hezbollah has its base, I think that, as cold as it sounds to say, the world accepts that, and that's the reality on the ground, and that will continue to be.
So it seems like the largest risk, I would say, to most of the investors here is, does it pull in regional players, and does it pull in global superpowers? What do you think is that like probability or that risk? I mean, I'm hearing from you that seems low, but I'd be interested to know, like, am I hearing that right? How big of a chance?
No, I think that's it. There's sort of these dominoes that have never fallen and can't be allowed to fall, because then you're opening a Pandora's box, and no one knows what's in it. So, you know, we have to think that, and Israel knows this as well, that as much as they would probably like to take on Iran, and they've done things like taking out nuclear production facilities in that country without ever taking credit for it, Iran itself has got to know that if there are Israeli troops facing off with Iranian troops, that's just a whole different level of engagement and conflict and risk. And Iran and Russia are close, and obviously we are incredibly tight with Israel, as is the European Union. And so then that domino leads to a more direct role for our country, for the European military establishment, for Russia, for China, and then you're at this place that the world can't get to, and I don't think the world will get to. And I think even Iran and Israel know that they can't play a role in making that happen, as much as they probably would like to just finish this, I guess, for lack of a better term, because the status quo is so untenable.
Okay. So the question in there, do you have money invested in arms, ammo, or supplies over there, and the market? I can answer a little bit there, and then of course I'd love for you both to chime in, but exposure to ammo and supplies and invested in arms is going to be extremely limited based on the types of investment managers that we look at. And everybody's portfolio is a little bit different, so it's hard to answer for the whole group here. But when you buy an index fund, you get a little bit of the whole market, and most of our clients do have index funds. So you get some exposure to almost the entire world, and you get some exposure to almost every industry. And then, but that is so like fraction of a percent, a fraction of a fraction of a fraction of a percent, that those particular areas, I'll tell you this, are not areas of high focus for any of our managers. Correct me if I'm wrong, Tim and Ryan, but at least the managers we tend to use, I don't know of any of the strategies that have a heavy focus on arms in any way, or on, I mean, they're international stock managers, but they're not focused a lot in this particular part of the world, from what I can tell.
Yeah, no, I think you're right. And there are only so many players at scale in that space anyway. The Boeings, the Lockheed Martins of the world, the Raytheons. There have been so much consolidation in the defense complex in the US in particular over the last 25 years that you would have to run a super concentrated portfolio, really a handful of stocks to kind of make that bet. And, I know that's not how we build portfolios. That's a very tactical, sort of short term, obviously very, horrific headlines, and you sort of participate in that. But if we're right about where this plays out, that's going to be a sort of short term, a very, very short term trade.
And a pretty high risk trade, right?
And pretty high risk as well.
Yeah.
And so if you're going to hop in, you're going to have to know exactly when to hop out.
Yeah.
So I think you're speaking to it the right way.
Well, the question may have come. Go ahead, Ryan. You go. Yep.
Yeah, I was just jumping in to say that defensives or defense stocks make up probably a single-digit percentage in the S&P, and then it kind of blurs the line between aerospace and industrials as well. So your Boeing doesn't just make military supply components for fighter jets; they also make passenger plane parts and planes like that. So your revenue sources are diversified even within those defense industry stocks as well. So it's, in terms of direct exposure, it is, to your point, really, really limited as well.
So Ryan, beyond that question though, beyond the question of like exposure to that, as you look at data and as you look at analysis, I feel like what are you noticing about the conflict in general?
I mean, the conflict in general, I think the bond yield dynamic has been really interesting, watching rates tick very high, very short. And then we had the conflict. So, there's an unknown there with the holiday that Tim pointed out. The fact that bond yields have come down as predicted is encouraging. The longer term or bigger term picture for bond yields, I think, is a lot more of an interesting discussion as we get into the Fed, as we get into the jobs market data. We can certainly talk about that as well. In terms of the conflict, I would share pretty much exactly the same rhetoric that Tim pointed out there. I don't think we can fast forward into the future and just get to the other side of a conflict like this. Things are fluid, so let's not jump to conclusions while things are so fluid and raw. That's kind of my outlook there. It's a tricky situation for sure. Keeping an eye on the oil market. So I think oil peaked last year at 130 a barrel. And we're still sitting near, $80, $90 a barrel. So, even with the spike, we're not even, approaching where we were when supply was really constrained in that market. So that's been another observation as well. So
that's good. Okay, before we move forward, I would say to all of the attendees out there, I'd love for Tim and Ryan. I feel like these are good opportunities to get these very smart people behind the scenes talking about what they're looking at. So that's where I'm headed. So if everybody's okay and I knew we needed to talk about that first, and Tim and Ryan both, first thing they said to me is, hey, we're planning on talking about this, right? So yeah, that we needed to cover this first. But as we move on to like, what are Tim and Ryan thinking about behind the scenes? Maybe throw any questions that you may have. If we need to go back, we can. But Tim and Ryan, let's dive into that. And I would love I think our investors, they get a lot of conversations from their advisors about like taxes and financial planning and projections. And we talk to them about investments, but I think it would be super helpful to know, okay, these are the people behind the portfolios. What are you noticing? What are you liking? And what are you nervous about? That would be wonderful.
Yeah, so Zacc, I'm going to go ahead and share my screen and bring up some slides to help facilitate that conversation. As it sounds like Tim had a couple thoughts to start out.
Hey.
Quickly, something that's not in the deck, and again, the narrative hasn't changed. We, as you know, like Capita, we all try and take a long-term view. The other bit of news last week was Washington, D.C., and Speaker McCarthy losing his job, which had never happened, right? And obviously the events in the Middle East take precedent, given the scale and the loss of life, and how tragic they are. But there's also that in the background, because the U.S. government can pay its bills till about mid-November. So people are still worried about a shutdown. Avoiding the shutdown last month sort of cost the speaker his job. He upset some folks in his caucus. There was a vote today to put Representative Scalise forward as the potential replacement. Again, we're not political scientists, though we follow politics closely like you all do as well. You know, our thinking is the horrific events in the Middle East make it more likely than not that the Republicans coalesce around a speaker sooner than later. You know, the world wants to know that the U.S. government can come to the aid of Israel. Not to get in the politics of it, but it seemed like one of the big sticking points around a longer term spending agreement, or the Congress passing the different appropriations bills, the 12 bills it's supposed to pass, was aid for Ukraine. And our thinking is the events in Israel make it more likely, one, you get a speaker sooner than later, and two, you get a longer term funding deal in place, and that deal probably includes funding for both Ukraine and Israel. And Israel is going to need some financial help and some help in equipment if they're going to move forward with what they've hinted at. So DC was in the news last week. Obviously, the Middle East this week. We think DC will be back in the news, and we just wanted to share a few thoughts there. And that all said, to Ryan's point, the big story the last couple of months has been this big backing up in bond yields, the Fed's rhetoric around higher for longer in terms of interest rates, and what that did to stocks in August and September. So we'll talk about that. But I'll hand it back to Ryan, and we'll sort of take a step back and talk about the trends that we see in place, and to Zacc's point, some of the data points that we're paying the most attention to, if that's okay, as we think about portfolio construction into year end. We're in the fourth quarter. It's the years go by faster and faster. So Ryan, take it away.
All right, thanks, Tim. So the three things that we're looking at, Zacc, and everyone on the call, are the idea that a new bull market is here today. It's a long period of time that we're optimistic about for stocks and equities and risk assets. There's also this thing we're focused on called a recession. You may have heard of it. The economy goes south and people get upset. So we're really focused on that, and the idea that we're not out of the woods just yet on a recession. We've delayed it and pushed it back for now, but there's still quite a few caution signals out there. So we'll go through that, and then Tim just teed up a little bit about what's going on in DC, and it's a little bit early, but we're thinking about the 2024 election, and we think your clients will be thoughtful about that as well. So we'd like to touch on that too. So those three subjects are really top of mind right now. So I'm going to go ahead and just kick it off and just talk a little bit about why we think the new bull market is here to stay. Even though we've had a pullback in August and September and a little bit into October, we still think that's really a pullback within the context of this new bull market. So if you go, rewind back to October of 2022, about a year ago, we had reached really a low for stocks. So the outlook was really negative. Inflation was rearing at 9% or higher. The outlook for the Fed was that interest rates were just going to keep going up and up and up. Sentiment was awful. Earnings outlook was poor. So we really had a low point, and that's kind of our beacon or line in the sand, if you will, that we really started to see things improve from there. So since then, we've had falling inflation. We have an improved monetary policy outlook. Earnings have held up better than expected. The consumer has held up better than expected. We've had money come off the sidelines a little bit, and some of that is reflective of institutions being caught off guard. So some big firms were still really bearish when they should have been a little bit more bullish. So we saw that. And the big picture, these bull markets tend to run for a really long time. So just some visuals to support what was going on about a year or so ago. So you can see here some survey data just pointed out, if you look at that red circle in 2022, just how bearish everybody was, whether it be consumers, individuals, businesses, investors, et cetera. Everyone was just really negative on the outlook. Valuation was also another pivot point. So you can see that low point down below 16 times earnings for the S&P 500. And that was enough to convince Wall Street to step in and lean into risk assets since then. And then since that low point, the S&P is actually up 20%. So with all the scary headlines out there and the newsreel that seems pretty negative, I think most folks would be a little surprised to see that we're up 20% since October, right? So I think the pullback of late has been 5 to 10%, depending on what type of equity exposure you have. But within that context, we're still up 20%. So that's pretty good, right? So yeah, the recent bear market that we just exited about a year ago, or actually we exited that bear market about June of this year, not necessarily a year ago. But when you do exit a bear market, the future returns tend to be pretty good. So if you look out a month, 3 months, 6 months, and 12 months, dating back to World War II, anytime you've come out of a bull market, history is on your side for performance and returns.
Okay, wait, can we pause on that just to really,
Sure.
Let's look at those numbers. So you're saying after you exit a bear market, and are you saying from the low or from,
yeah,
from where?
So we're defining a bear market as a 20% pullback in stocks. And then once you clear that and get back to where you were, the returns from that point on.
Oh, so once after you've recovered from the full bear market that you experienced, now we're talking about from that day forward for 1 month, 3 months, 6 and 12.
Correct. Yeah.
Okay. So then for a year after, so the idea is you've already made all your money back after the bear market, and then add on 12 more months, the average return is 9.3% for stocks, with it being positive 62% of the time.
You got it.
Okay.
Perfect. Yeah. And then this most recent bear market was a very, very long one. The longest dating back to 1948. It lasted 248 trading days. So it felt, pretty bad for a long time. And, coming out of that is a reason to be optimistic, we think, for a new cycle to get legs. So that's kind of the context of this slide. I think the next slide will actually help put it in context too. So on this one, we mapped out dating back to 1957 or so, peak to trough performance of the S&P 500 in different cycles. So whenever there was a bull market and a bear market, the peak is in that blue line, and then the start of the trough is in that red line. So you can see that the down years and the length of those down years is a lot shorter and less severe compared to the run that you get up, or that you get when stocks run higher. And on average, I think the S&P, we have noted there, returns 178% on average during bull markets, and they last for about 1,000 days or so. So, that's really encouraging stuff. And I circled there all the way on the right where we were in 2022 and into 2023. So you can see coming out of that, we're pretty much in inning one of this new bull market that we hope will have some long-lasting impacts for portfolios. So just to run real quickly some of the factors that we improved here. So cooling inflation was a big driver of returns over the past year. We've seen consumer prices and business prices paid improve. That doesn't necessarily mean that they're back to pre-pandemic levels, and we've seen some improvement there. There's still some more to go, but it's at least encouraging that we're going in the right direction. And then the outlook on rates has improved. So this is what the futures market is pricing in for the expected Fed funds rate to be all the way out through the end of 2024. So the market's betting that we're going to go sideways on rates for a while, and then eventually they're going to start to cut. And if it's the end of an interest rate hike cycle, that's really encouraging for stocks as well. We have some history behind that if anybody would like to follow up after the call in support of those numbers. We also dodged a banking crisis back in March. I think we've talked on that one in previous calls, so I won't spend too much time there. Better than expected earnings have been good. Outlook is positive for Q3 coming into the final months of the year. We talked about large institutions being off sides. We talked about August, September being a pullback within the context of that new bull market. So this kind of puts into context that some of those headlines that we saw rates move higher. And maybe I'll pivot to Tim after I run through these slides. He can comment on rates themselves. And then once you have a good first 6 months of the year, history is on your side for the back half of the year. So there's still some encouragement there that the data suggests that if you have a good start, you'll finish strong as well. And then at the end of a rate hike cycle, as I alluded to, once the Fed is done hiking, and in the time between a new cut, that is a really encouraging time period for stocks as well. So on average, 12 months after the last rate hike cut, you get about 12% return on average. And you can see the most recent cycles there back that up as well in the near term. And then finally, seasonality is the big one. So August and September were historically really the worst months on average for a calendar year for the S&P 500. And that goes, there's a nuanced explanation for that. It goes around corporate planning, redistribution of expenses and things like that, and money coming off the sideline and back into the market in October, November, and December. So that we're really encouraged by the strong finish that we could have to the end of the year after some unpleasant months. So maybe before I pivot to Tim, I'll see if there's any questions there, and if not, maybe he can comment on the backup in interest rates and how we got to there.
I do have a question on one of your slides. There is a question here about large cap versus small and mid. Maybe we talk about that a little bit later, I think. But will you go back to the one about inflation? Like the cooling inflation was helpful.
Sure. Yeah.
So I know that the three of us have had email exchanges about articles that cover this in particular, right?
Yeah.
And I'm going to get to a question here, but to catch everybody else up to that email chain, I think, Tim, you first sent it to me, some articles that talked about how politicians talk a lot about how they've taken the rate of inflation from 9% down to 7%, meaning
right.
they feel good about that, and they promote that as a really good thing because they have cooled inflation. They have slowed down the rate at which things are getting more expensive. But the general public looks at that and phrases it a very different way. The politicians are like, see how much we've cooled the rate at which things are getting more expensive for you. And the public is saying, they're still getting more expensive faster than my income is going up. Therefore, maybe make that number a negative number so that not that we want that, but that's the way that an individual feels, like help make it less expensive for me to live. So anyway, there's a disconnect, and there can be actually some political fallout when politicians talk about how great of a job they're doing with inflation, while the rest of us feel the higher prices grow and grow and grow. And so anyway, Tim and Ryan have been good to educate me on this. And I guess my question, giving everybody that background here, is it feels a little bit confusing because cooling inflation is typically done with rising rates or increasing rates and pushing rates, hiking rates, I guess let's call it. So that has a negative impact on business growth and has a negative impact on investor sentiment. So we have this cooling of inflation, which is done by hiking rates, which then causes businesses to feel less certain and less comfortable growing and borrowing. Anyway, so help connect the dots here, that while that's a negative thing for businesses and maybe a negative thing for consumers, how does that actually become a positive catalyst?
Sure. I think the most important direct tie you have here is the connection between inflation and what the Fed's goals are. So if you think about the Federal Reserve, the dual mandate is to have stable and steady prices and have full employment. Well, we have full employment, but we let prices get out of control, right? So if we have if the Fed is able to raise interest rates and bring down inflation, then they'll be able to check that second box and hopefully not lose too many jobs in the process. So they're not necessarily concerned about you or I paying double the price for a package of ice cream at the supermarket or anything like that. They really would just want to see stable prices and get back to that stable price environment. So that's kind of the directional optimism that we have on inflation. So if it's coming down, that means the Fed is more likely to take their foot off of the gas with their interest rate hikes. So that's kind of why we have this slide and slide 11 in back to back here. So if we talk about inflation coming down, well, that's good. That means the Fed will ease up on interest rates, right? So that's kind of the most direct tie that we have to investors to be optimistic there.
Oh, sorry, I didn't mean to interrupt you there. So investors are
Yep.
looking forward to saying, hey, because inflation has cooled, rate hikes will be less likely. And because rate hikes are less likely, stocks should do better in the future. And that's why it's a catalyst. Am I connecting dots okay there?
Yep, that was perfect.
Okay.
Yeah.
Okay.
Tim, do you have
Follow me.
anything to add there?
Yeah, and sort of back to the political dynamic of this and trying to bring down the rate of change. You know, the CPI. So we got the producer price index data today for last month. We'll get the CPI, consumer price index data for last month tomorrow. And today's PPI came in a little bit hotter than expected, spooked the market a little bit, but the market still ended up. So October, again, it started pretty well after a couple of rough months. So the calendar so far is behaving the way history would tell you it would. And we'll see what we get with the CPI tomorrow. But, you know, back to the political dynamic. So if you're Joe Biden and the CPI goes from 9% to 7 to 5 to 3 and change, you know, you're gonna say what a great job you're doing. But to your point, Zach, you know, or to use Ryan's example, if a quart of ice cream is still $1.50 more today than it was 3 years ago, and it's going up in price, but going up only 3% and not 9%, people are still not going to be happy until they forget that it was $1.50 cheaper 3 years ago, right? That absolute level really sticks. And I think it's that absolute level of pricing is the biggest catalyst that the administration's numbers are so awful when it comes to handling the economy. It's funny. I'm old enough to remember, you know, when a gallon of gas was 75 cents or even a little bit less. But, you know, I kind of forgot about that and I got used to $1.52 and I was okay with that. And now I'm not okay with $4, but maybe in 15 years I'll forget that I was mad about $4 and I'll get used. So consumers, and maybe rightly so, may not be in a really good mood until, you know, 2035 when we forget what prices were like pre-pandemic. But if you're Joe Biden, you're going to focus on rate of change. That's what the Fed cares about too. And to your point, if that allows for a more benign interest rate environment without the outcome being a severe recession, the market's going to like that. Because there's one thing, we know this, there are a couple things the stock market likes, but boy, one thing the market really likes is low rates and free money. It's Wall Street loves that. So if we get back to lower rates, people will be in a really good mood. The other thing I'd say, it was, you know, when we got going with this act, you were talking about, you know, what are some of the things we're focused on and paying the most attention to. You know, I think, you know, the way to maybe think about markets is to kind of, you know, broadly step back and think about the construct or the environment that equities are existing in. And so over the last year or two, they've been existing in an environment where earnings were going down and rates were going up, right? And the Fed was hiking at an historically aggressive pace. And now we think, barring some inflationary shock, rates have peaked, yields have likely peaked. So bond yields are coming down, rates should go sideways and down, and earnings, after being down year on year 3 quarters in a row, there's a good chance they'll inflect positive for the third quarter. So, you know, markets, there's volatility, but they tend to kind of move in one direction or another. Bull markets for a couple, 4 years, bear markets for 12 to 18 months. And the narratives tend to be pretty consistent. So we do think we're in an environment now where earnings will help, not hurt. Yields and rates should help, not hurt. And if that's the broad backdrop or underpinnings, you can understand why we think, you know, in fits and starts, you know, stocks will continue to move higher, because a lot of the things that we're weighing on equity prices are flipped or close to being flipped. So that's a lot of what we spend our time on, trying to take the individual data points and knit them together into what is the broader narrative or backdrop, and is it positive or is it negative? And we think a lot of it's flipped from negative to positive.
Got it.
Yeah.
Okay.
And,
A couple. Go ahead, Ryan. Well, let's answer the questions. Ryan, you go, but then I think there's 3 in here. Let's make sure we
yeah,
get time for those.
I was going to tee up one of the questions I saw come in about small cap. So we don't necessarily dedicate a section to small cap in the deck here, but it's noticeably lagged large cap. And Tim brought up the idea of cheap money being attractive to Wall Street. Well, small caps are even more sensitive to that dynamic. So borrowing costs hit small businesses and smaller cap companies more than they do large cap companies. So larger cap companies can kind of pivot and diversify some of their funding sources away from that risk. So if there is a reason to be optimistic about small caps, it's that the end of this interest rate cycle and pivoting towards a more benign rate environment should really help small caps. Another impact for small caps as well is just the state of the economy. So if we get any positive news on, say a soft landing being confirmed or a no landing scenario, that would be, you would think, do really well for small caps as well. So, I just wanted to acknowledge that question real quick.
Yeah, I think that the part of the reason behind that question is we diversify portfolios pretty broadly. And I've actually heard diversification is always having something you hate in your portfolio. That's just
a good way to put it.
It's the part of the game that everybody's frustrated by it, right?
Yeah.
And large cap stocks have done so well and for quite a long time. I mean, it used to be that you would count on making more money by buying smaller companies, and because you're taking on more risk, you're benefiting from that, I should say. But the last little while, and I say little while, I mean years, large caps have really just destroyed small caps. And I think that's part of the diversification, is that when markets do well, there is better opportunity in small cap stocks. So everybody's portfolio is going to be different, and you're going to have different levels of each of these based on your time frame. I'm thinking someone really young. Like personally, I'm kind of in the middle, unfortunately. I used to consider myself young, but now I feel like I'm in the middle of the workforce. And so I end up with more small cap stocks than a lot of our clients do, because I'm anticipating that as markets do well, that smaller companies should have bigger swings. But I think the reason this question comes up is because a lot of people will forget about that and compare their portfolio maybe just to the S&P 500 or just to the top 10 or 5 stocks in the S&P 500 and wonder what's going on there. And that's just context. I don't have there's nothing to say other than that's what I think is going on there. And to be aware of the benefits of diversification and be aware of the downsides of diversification, actually. I think that some people are over-diversified. And one of the specialties that Orion has brought is what's called semi-concentration. So we find a lot of portfolios that they try to be active, they try to do something different than the index, and then they buy so many pieces of the index, they look just like it. And so then they end up kind of spinning their wheels and paying higher fees for nothing. Anyway, so it's just something to be thinking about. I think we'll move forward to some of the other questions. So let's just touch briefly on in the chat, there's how does the growing national debt factor into your forecast? I think that's pretty related to the dollar conversation we'll have in a month, right?
Yeah.
And so maybe let's make sure we hit other questions, since we have 2 minutes or 10 minutes left in 2 of those questions in there. But maybe you could touch on that briefly. So how does the growing national debt factor into your forecast?
It's starting to bite, not so much the deficit, but the servicing costs, right? Because in theory, the government can sort of borrow as much as it wants because it spends in its own currency, but because of the backing up in bond yields, debt servicing costs are running almost equal with the defense budget, right? So that's going to force either some hard choices around discretionary spending, or the government could also, if they wanted to, and I'm not saying they should, do away with the debt ceiling and just borrow a bit more to make sure they don't have to reduce spending on discretionary programs. Because essentially most of what the government spends goes to Medicare, Medicaid, Social Security, the Pentagon, and then interest expense. And the rest that's left over, which isn't much, is everything else. So we do think you're at a point where it's gonna force some harder decisions on Washington, D.C. And if you are the political class in Washington, D.C., not that they would ever say this publicly, you're probably rooting for a bit of an economic slowdown and a bit of a backing off in bond yields, because that's going to make your life a lot easier on a go forward. basis. We're not worried about things from a structural perspective. In theory, the U.S. doesn't need to default, could never default if it didn't want to, but it will force some tougher decisions on discretionary spending in the next Congress and into the 2024 election.
Okay. Thank you. How about housing? So how can you address the housing market? Will prices continue to rise or stay stable versus lower?
My 2 cents, and Ryan can weigh in for sure, is that prices won't continue to rise. They can't. Affordability is too stretched. Affordability is at sort of a multi-decade low because 30-year fixed mortgage rates are 8%. So nothing goes in one direction forever. So I remind myself of that when things are awful, and I remind myself of things of that point when things seem perfect. I would think prices will have to weaken or at least go sideways, if not come into the new year. You have a lot of multifamily apartment unit supply coming online in a historic amount. And I think while you haven't had a lot of single family home inventory, the multifamily inventory that's coming this quarter and the first quarter of next year will weigh on single family pricing, which I don't think is a bad thing because people have been so priced out of that market. I don't think it's 08 and 09 because I don't think we have the same supply dynamic, but I just don't know how prices can continue to go up when mortgage rates have gone from 3% and change 3 years ago to 8% today. I just don't think it's sustainable. I don't think it's a bubble. I don't think it's an 08, 09 repeat, but my best guess is prices go sideways and then come in a bit next year, which I think will be okay.
Yeah, I think Orion, go ahead.
Yeah, I was just gonna say we just don't have the supply scares that we did from 15 years ago when we had the big housing crisis. So even though prices might come down a little bit, to Tim's point, we don't see a crash or anything like that. So I just thought I'd make that crystal clear as part of our comments there. So yeah, buyers are going to be on the sideline. Transaction volume is going to be low. The tertiary suppliers to the housing industry is going to be a little bit slower. So that's a headwind. Folks like real estate agents, mortgage companies, construction, plumbers, copper production. So all that's kind of going to just be a little bit of a malaise until we get more transaction volume. And I think to get more transaction volume, to Tim's point, we just need either prices to come down a little bit to feel like buyers have a chance at making a payment that they can do, or have rates come down for the same reason.
Yeah, it seems as though I've met a lot of people who have made a decision to wait for prices to go down to find a new opportunity that's going to be better. Now, you may have a better monthly payment because rates may drop, but I'd be cautious of putting too much weight into the possibility of being able to buy real estate at much lower values in the future. You might be able to time that just right, but the reality is it seems more likely, and I don't know, you guys, I would love for you guys to add to this, but it seems more likely that the real estate prices of especially residential real estate just doesn't climb as fast, and everybody else catches up in terms of income or interest rates improve or other factors that make it more affordable. That whole affordability index, like, I think it could improve, but not necessarily because prices come down, because I think it could be other factors improving.
Yeah, lower borrowing costs would be a huge help for sure, which again, we'll come back to the Fed and the 10-year. I mean, most interest rates are keyed off the 10-year, including the 30-year fix. I think one good thing, and I feel for people, given the spike in housing the last 3 years who haven't participated in that, I do think Americans think about housing the right way after thinking about housing, at least a lot of folks, the wrong way in 08 and 09, when everybody was looking to flip houses and they almost saw their house as a stock. And I think the housing crisis was so severe, and I lived through it as a homeowner outside of DC, that people came back to the idea that, okay, I live here, I pay myself rent, over time I build equity, over time there's real estate and price inflation, so that's a good thing. And in 30 years from now, I'm going to have a really nice nest egg tied to the house. And I think that's good. And the Fed's also done some really interesting research, and this gets to your point, Zacc, I think, about price, that because of the work from home dynamic, and I'm sitting in our house in Wayne, Pennsylvania. I was in Utah yesterday. So flew back last night, working from home today. That, the Fed thinks that prices of homes have structurally reset anywhere from 15 to 20% higher because of the way they're used now from a professional perspective. That the pandemic really did change real estate dynamics. And I think that's true because most of the folks in our team work in the office 3 days a week, and then they'll spend 1 or 2 days at home working, and that changes the value of your house. So I do think some of that's structural for sure.
So I'm going to hit the Social Security thing really quick, and since we're running low on time here, and I'll just tell you, for most of our clients, 50-year-old to 75-year-old, I don't worry about Social Security being around for you at all. While there are concerns with government debt and government spending and budgets, they have so many levers that they will pull and change full retirement ages, change benefits, change a few things, and they tend to grandfather in those who are already on those benefits, and they tend to affect the rest of us who are in line to get on those benefits. So in other words, for most of you, our clients, I don't worry about this one at all, but we could, for the sake of time, I'm going to move forward and we can talk about more of the data about the actual fund and when it's scheduled to run out, but the actual fund has actually grown recently. And anyway, we can talk about all of that. But I wouldn't worry about it for most of our clients. I don't worry about it for most of our clients. I think I'll probably be means tested out of it. The people who save for retirement, who are 20, 30 years away from it, I could see myself not getting it, but our clients are going to be in good shape. This and the other one about labor disputes, I'm gonna jump to this one about the recession that wouldn't arrive. And if we have time, we'll do the labor disputes question. But I thought that was an interesting headline as well, Ryan. You guys got us with the clickbait there. Tell us what this is about.
But are you referring to the labor union strikes?
No, I'm talking about the recession that wouldn't arrive. That was a really good title. Like what's behind that?
Yeah, Tim, do you want maybe just because we have limited time, Tim, do you maybe just want to call out a few most important talking points on why it hasn't arrived?
Go down one slide. There you go.
Yeah.
So the recession that wouldn't arrive, we thought the economy would be weaker by the time we got to October. It's been stronger. And we think that's because of excess savings through the pandemic, the government's largesse as we shut down the economy. That kept the consumer in the game. The labor market's been more resilient than we thought it would have been, given what the Fed has done in terms of shrinking its balance sheet and hiking rates, and corporate America. And I never underestimate corporate America, proved pretty adaptive and resilient over the last 24, 36 months. And you sort of put all that together, and most folks think the economy grew somewhere between 4 and 6% in the third quarter, which is pretty phenomenal considering, again, what's happened on the monetary policy front and the geopolitical construct. And all of that has got some people talking about sort of the Goldilocks economy for those folks who remember the 90s, where inflation was moderate, growth was pretty good, and could we get back to that? My best guess, and Ryan and I go back and forth on this all the time, is that the recession is delayed but not dodged, that it takes a while for interest rate hikes or interest rate cuts to impact the real economy. And you're starting to see some of that. Credit card rates are 25% plus for some people, and mortgage rates are 8%. I just don't know how you do all that in a consumer-led economy and not see some impact. And there are some signs that the jobs market is beginning to weaken, as well as including wage inflation. So our thinking is we are going to get some sort of soft patch, probably in early 2024. We thought it would have been late 2023. It doesn't have to be terrible. It doesn't have to be a meaningful downturn, but you can't take rates from 0 to 5.5% and shrink the Fed's balance sheet by $90 billion per month and not get some sort of break on economic growth. So we think it's coming. We think it'll be manageable. And we still think the market's sort of offered up its pound of flesh last year, and that stocks will be okay. There'll be volatility, but risk assets will do okay, even if the real economy stumbles a little bit into the first half of 2024.
That's perfect.
So.
You guys, thank you so much. So we're coming up on the hour and we want to be respectful of everyone's time. So we want to wrap up there. The questions, if you had a question that didn't get answered, reach out to us at Capita. Tim and Ryan are wonderful to be resources for us, even outside of these regular calls. And we're happy to have you join these. Super impressed with the questions. Our investors are thinking about things very carefully, and you're smart. You know what you're talking about. So we respect you. We appreciate you investing with us, and hope that these and our other sessions are useful to you. Hope to see you in November. We're going to try it in person. This will be the first time back. We're going to be at the Salt Lake Community College just down the street in the auditorium. So that should be great.
Yeah, really looking forward to seeing everyone. Thanks again for the invite.
Yeah, of course. Thank you, Ryan. Thank you, Tim. Appreciate you both.
Appreciate it, Zach. Thank you, everybody.
Bye.
Take care.